Warren Ingram from Galileo Capital and 2011 Financial Planner of the Year, who's taking us through his sensible investment strategy. And of course, that sensible investment strategy has to unfold in the current market volatility. Yeah. So we're waiting to hear what you have to table for us.
I think if you look at what's happening at the moment, I mean, much of what we see in the world's markets is almost predictable irrationality. I mean, it's predictable insanity. You know, and I think you listen to a European government minister saying something positive today, and the markets jump up 5%. And one of the things he says is, we're going to chat to the Chinese to see if they can also help. And then the next day, the Chinese come out and say, well, they chatted to us, and we're not going to help. And the next day, you know, the market drops 5%. And I think
so. It's good times for traders. You just listen to positive, negative comments. The market's going to move on them. Yeah,
and actually, that's exactly what's happening. I mean, it's predictably irrational. If the market jumps up 2 or 3 days in a row, where we've had fantastic movements up, you can just short the market and you know it's going to come down, and the same the other way around. I mean, for me, I mean, I've been in this since '96, and I can't say I've seen this kind of predictable irrationality before. And I think what worries me though is that the average private investor gets caught in this, and usually what happens is they lose money. They lose money every single time. And because I think they're listening to people like us.
Warren, what sort of mistakes do you think they typically make?
They're typically...
They're listening to people like you.
They're listening to people like us. And,
you know, that's what Warren was saying before you cut him off.
We sit here and we say, you know, this is a fantastic share, buy it, and they go and buy it, and the next day the European minister says something negative and the market goes down. And unfortunately, they're buying it with money that they can't afford to hold. You know, they're trading. So I think that's one of the big mistakes. I think the issue around timeframes here, you know, timeframes used to be 3 to 5 years. Now they're 2 to 3 days to, you know, weeks or months, and because the volatility carries on so much, I think what happens is that sensible investors who normally quite rational are becoming increasingly irrational, and I think that's really the main danger here. So if you want my sensible strategy, it's kind of go back to basics, you know, investment 101. Don't use money in the markets that you can't afford to leave there for the next 3 to 5 years, because this kind of volatility and this irrationality could carry on for a very long time. And I think you can't lose faith in the fundamentals. The fundamentals apply.
Last night I was chatting to Leon Camphor from ASISA, and a big trend into asset allocation funds, which obviously gives you the diversification. Would that be obviously one of the key tenets of investing in current environment, diversification?
Well, so yes, diversification makes sense. Giving your money to a fund manager and hoping that he's going to second guess the market better than you can, I'm not so sure. Sorry, Kevin.
We don't do that.
Okay, all right, fantastic.
He's a completely different animal, Kevin Links.
So my concern is that I think you should actually take that asset allocation decision away from the market and away from the fund managers. Often what happens is they end up being a bit too conservative at the wrong times. So they've often been a bit overweight in cash at the worst possible times, where maybe if you're just stuck to your asset allocation, for example, if you think you need 40 or 50% in shares, and you've now handed that decision over to a fund manager who drops you to 20%, and the market's done incredibly well, and you've missed out, you've got no one to blame then but yourself. So I think
but is the average man in the street qualified to make those asset allocation decisions?
Well, probably as qualified as the fund manager is. I mean, I think the point is, you know, allocating an asset allocation decision to a fund manager is a deeply flawed way of doing things, because your decision around how much you should have in shares depends on things like how much you have in debt, how old you are, what's your time frame for investing, and that fund manager that you allocate your money to has no idea.
Well, that makes sense, Kevin. I mean, you have no idea how much debt I have.
That's true, yeah, but what the fund manager is trying to do is the fund manager is trying to provide a solution that people can buy into. What no fund manager is able to do is to say, here's a unit trust that you can buy into, but we're going to create many unit trusts that individually meet each client's needs. So there has to be a person that sits between the fund manager and the end client, a financial advisor like yourself, who's talking to the client saying, well, what exactly do we need to put you into, and then try and tailor that investment to meet those requirements. For the fund manager to meet each individual person's requirements, administratively, that's not really practically possible.
I think, and what happens now is it's a cop-out by my my industry colleagues. So what they do is they don't know what's going on. They're not brave enough to tell their clients the bad news, that the bad news in the markets is going to carry on for a long time. So what they say is, let's allocate the money to a balanced fund and let the fund manager decide. So I think what's happening at the moment is people are abdicating their responsibilities. And ultimately, you're asking the question, can an individual decide? Well, I think there's three factors that determine how much money you have in shares. How long have you got to invest? How much money do you need? Do you need income now? Because if you don't need income, you can afford to let your money stay in shares, or more of your money to be in shares. And then around your age, if you've got a long-term investment horizon, you can have more in shares. If you don't have a long-term investment horizon, and then obviously the idea is that you reduce your your exposure to shares.
If you profiled as the perfect person for equity exposure, taking those three criteria that you've set in,
yeah.
How do you feel about equities at the moment in South Africa?
Well, so what's interesting at the moment, the index is quite high. It's close to its all-time highs again. But at the same time, if you look at the value of the market, so measuring the PE of the market, it's been declining quite rapidly. So I think South Africa Incorporated is getting cheaper. Companies are sitting on an enormous amount of cash on their balance sheets. So I'm extremely positive. I think the last time we chatted on the show, I said the same thing, and my view hasn't changed. I mean, South Africa is a good investment story, and you just need to ignore the volatility and ignore the noise.
Warren, would you tend to advise your clients to adjust their portfolio at any time in the investment cycle? In other words, what you're tending to suggest at the moment is that people need to stick to basics, don't worry about the noise that's going on in the markets, and simply stick to their investment plan.
Correct.
Does that mean that under no circumstances do you decide to adjust your portfolio to reflect current conditions?
No circumstances. I guess if Bob invaded South Africa, Bob Mugabe, then maybe you change your view, but those would be the extreme cases. I think what I would say is you take market conditions into consideration when your asset allocation is being changed by the market. So if we use our example of 50% in shares and the market's driven your allocation to 70%, well, then go back to 50, sell and go back to 50. Similarly, if the market's driven you down below 50, then buy up again. But those are the real issues. I mean, the rest is second guessing the market and trying to predict what's going to happen, and we know nobody can make those predictions.